Hello everyone. Northstar VFD Consultancy welcome you to another video on Introduction to International Financial Reporting Standards, IFRS. In this chapter we will introduce you, IAS2, Inventories. We hope this chapter will help you to understand IAS2 Standard, Inventories. It includes accounting treatment for inventories, the amount of inventory cost to be recognized as an asset and carried forward until the related revenues are recognized, guidance on the determination of cost and its subsequent recognition as an expense, including any write-down to net realizable value, cost formulas that are used to assign costs to inventories, etc. Before beginning, let me introduce you. Northstar VFD Consultancy, a financial management consultancy, provides services of accounting and tax management, financial planning and analysis, budgeting, cash flow, financial reporting, internal audit. For more information, please visit our website www.northstarvfd.com. Let us look into IAS2 Inventories. The timeline of IAS2 Standard. In October 1975, International Accounting Standards Committee issued IAS2 Valuation and Presentation of Inventories in the context of the historical cost system. In December 1993, IAS2 Inventories is issued by replacing IAS2 Valuation and Presentation of Inventories in the context of the historical cost system, issued in October 1975. In April 2001, the International Accounting Standards Board adopted IAS2 Inventories. In December 2003, the Board issued a revised IAS2 as part of its initial agenda of technical projects. And subsequently Board has revised IAS2 in May 2011, November 2013, in May and July 2014 and January 2016. First, let us look into what is the objective of IAS2 Inventories. The objective of this IAS2 Inventory Standard is to prescribe the accounting treatment for inventories. A primary issue in accounting for inventories is the amount of cost to be recognized as an asset and carried forward until the related revenues are recognized. IAS2 Standard provides guidance on the determination of cost and its subsequent recognition as an expense, including any write-down to net realizable value. It also provides guidance on the cost formulas that are used to assign costs to inventories. IAS2 Standard and its scope and scope limitations. IAS2 Standard applies to all inventories. IAS2 excluded the following from inventories. 1. Financial instruments according to IAS 32 Financial Instruments, Presentation and IFRS 9 Financial Instruments. 2. Biological assets related to agricultural activity and agricultural produce at the point of harvest, according to IAS 41 Agriculture. 3. Costs incurred to fulfill a contract with a customer, in other words, work in progress in a contract, that do not give rise to inventories, or assets, that are accounted in accordance with IFRS 15 revenue from contracts with customers. Even though certain inventories are within the scope but IAS2 Standard but does not apply to the measurement of inventories held by 1. Producers of agricultural and forest products, agricultural produce after harvest, and mineral products, to the extent that they are measured at net realizable value in accordance with well-established practices in those industries. When such inventories are measured at net realizable value, changes in that value are recognized in profit or loss in the period of the change. 2. Commodity broker traders who measure their inventories at fair value less costs to sell. When such inventories are measured at fair value less costs to sell, changes in fair value less costs to sell are recognized in profit or loss in the period of the change. Before proceeding to further details of IAS2, let us look into some important definitions specified in IAS2. Definition of inventories. According to IAS2, inventories are assets. 1. Held for sale in the ordinary course of business, such as finished products. 2. In the process of production for such sale, work in progress, or 3. In the form of materials or supplies to be consumed in the production process or in the rendering of services, raw materials. Inventories encompass goods purchased and held for resale, including, for example, merchandise purchased by a retailer and held for resale, or land and other property held for resale. Inventories also encompass finished goods produced, or work in progress being produced, by the entity and include materials and supplies awaiting use in the production process. Definition of net realizable value. Net realizable value is the estimated selling price in the ordinary course of business less the estimated costs of completion and the estimated costs necessary to make the sale. Net realizable value equal to selling price minus cost to complete and costs of sale. Next, let us look into measurement of inventory's cost. Cost of inventory. The cost of inventories, according to IAS2, shall comprise 1. Cost of purchase. 2. Cost of conversion. 3. Other costs incurred in bringing the inventories to their present location and condition. As stated earlier, the cost of inventory includes mainly cost of purchase, cost of conversion and other cost. Let us look into these elements in details. The cost of purchase is purchase price plus import duties and other taxes, transport, handling, and any other cost directly attributable to the acquisition of finished goods, services, and materials less trade discounts, rebates, and other similar amounts. Cost of conversion. The costs of conversion of inventories include costs directly related to the units of production, such as direct labor. They also include a systematic allocation of fixed and variable production overheads that are incurred in converting materials into finished good. The allocation of fixed production overheads to the costs of conversion is based on the normal capacity of the production facilities. The amount of fixed overhead allocated to each unit of production is not increased as a consequence of low production or idle plant. Unallocated overheads are recognized as an expense in the period in which they are incurred. Variable production overheads are allocated to each unit of production on the basis of the actual use of the production facilities. When joint products are produced or when there is a main product and a byproduct. When the costs of conversion of each product are not separately identifiable, they are allocated between the products on a rational and consistent basis. The allocation may be based, for example, on the relative sales value of each product either at the stage in the production process when the products become separately identifiable, or at the completion of production. Other costs. Other costs are included in the cost of inventories only to the extent that they are incurred in bringing the inventories to their present location and condition. For example, it may be appropriate to include non-production overheads or the costs of designing products for specific customers in the cost of inventories. It will be prudent to note that some of the costs are excluded from inventory. Examples of costs excluded from the cost of inventories and recognized as expenses in the period in which they are incurred are 1. Abnormal amounts of wasted materials, labor, or other production costs. 2. Storage costs, unless those costs are necessary in the production process before a further production stage. 3. Administrative overheads that do not contribute to bringing inventories to their present location and condition, and 4. Selling costs. Since we have seen example of costs should be excluded from inventory cost. What about finance costs? IAS23 standard about borrowing costs identifies limited circumstances where borrowing costs are included in the cost of inventories. Not every finance costs are included in the inventory cost. For example, an entity may purchase inventories on deferred settlement terms. When the arrangement effectively contains a financing element, that finance element, in another word, the difference between the purchase price for normal credit terms and the amount paid, is recognized as interest expense over the period of the financing, not included in the inventory cost. Techniques for the measurement of cost. Techniques for the measurement of the cost of inventories, such as the standard cost method or the retail method, may be used for convenience if the results approximate cost. Standard cost technique for cost measurement. Standard costs take into account normal levels of materials and supplies, labor, efficiency, and capacity utilization. They are regularly reviewed and, if necessary, revised in the light of current conditions. The retail method for cost measurement. The retail method is often used in the retail industry for measuring inventories of large numbers of rapidly changing items, with similar margins for which it is impracticable to use other costing methods. The cost of the inventory is determined by reducing the sales value of the inventory by the appropriate percentage gross margin. The percentage used takes into consideration inventory that has been marked down to below its original selling price. An average percentage for each retail department is often used. In IAS2 Standard, so far, we have learned IAS2 objective, scope and scope limitation, important definitions, cost measurements including what other costs should be included in the cost of inventory, and what other costs should be excluded from the cost of inventory. Since we have already learned what constitute cost of inventory in theory, now let us look into an example of cost of inventory computation in real-world situation. Here in the screen you can see an illustration. You may note that Messrs. Sunshine Company LLC is a producer of antibacterial hand sanitizer. The information relates to inventory of finished goods as given here. Maximum production capacity as well as normal production capacity has given. Further, details of cost of raw material such as ethanol, isopropyl alcohol, glycerin, sodium polyacrylate, color, fragrance, labor cost of production crew, packaging cost, factory manager and company manager, electricity cost, storage cost, marketing cost, finance cost, cost incurred for acquisition of plant and machinery etc. has given. Please find our cost of 1 unit of finished goods inventory. Here in the screen you can see computation of 1 unit of finished goods inventory. Let us look into details how unit cost of finished goods inventory is arrived. You can find here that cost included in the cost of finished goods inventory are unit cost of raw material, ethanol, isopropyl alcohol, glycerin, sodium polyacrylate, color, fragrance. General material cost 12,000 allocated over normal capacity of 200,000 unit. Then salary of production workers, salary of production manager, factory electricity cost allocated over normal production capacity. Then packaging cost etc. added into the cost of inventory. In addition to that, machinery depreciation cost for the month is allocated over normal capacity units. You may take note that acquisition cost of plant and machinery was 120,000 with 5-year economic life. That resulted in 2,000 per month depreciation, which is allocated over normal production capacity units. Further, you may note that all monthly costs involved are allocated into 1 unit cost based on normal production capacity units, not based on maximum production capacity units. Here in the screen you can see cost excluded from the cost of finished goods inventory. You can find that costs such as salary of a general manager, marketing costs, storage cost of finished hand sanitizer bottles, interest paid to supplier for deferred payment against purchase of raw material, excluded from cost of inventory. This excluded cost should be treated as general, selling and administrative and finance cost for the company in their current year profit and loss account. This is end of this video on IAS2, Inventories, Part 1. Thank you for watching. See you next time with Part 2 of IAS2, Inventories.